Hello and welcome to our video on the Sharpe Ratio. If you're an investor, you've probably heard the term Sharpe Ratio before. But what exactly does it mean? In this video, we'll dive into the details of the Sharpe Ratio and explain how it can help you assess the risk-adjusted performance of your investment portfolio. What is the Sharpe Ratio? The Sharpe Ratio is a metric that measures the excess return of an investment relative to its risk. It was developed by Nobel laureate William F. Sharpe in the 1960s. The formula for calculating the Sharpe Ratio is simple. It's the excess return of an investment divided by the standard deviation of that investment's returns. Sharpe Ratio equals divided by standard deviation of investment. The Sharpe Ratio essentially tells you whether the extra return you're getting from an investment is worth the extra risk you're taking on. It allows you to compare the risk-adjusted returns of different investments and assess whether they're worth investing in. For example, let's say you're comparing two investments, investment A and investment B. Investment A has an annual return of 10%, while investment B has an annual return of 12%. However, investment A has a standard deviation of 12%, while investment B has a standard deviation of 18%. The risk-free rate is 2%. Using the Sharpe Ratio formula, we can calculate the Sharpe Ratio for each investment. Sharpe Ratio of investment A divided by 12% equals 0.67. Sharpe Ratio of investment B, 12%, 2% divided by 18% equals 0.50. As you can see, investment A has a higher Sharpe Ratio than investment B, which means that it has better risk-adjusted performance. Even though investment B has a higher return, it also has higher risk, which reduces its Sharpe Ratio. So, what does a Sharpe Ratio of 0.67 or 0.50 really mean? Generally speaking, a Sharpe Ratio of 1 or higher is considered good, while a ratio of 0.5 or lower is considered poor. However, the ideal Sharpe Ratio will depend on your personal risk tolerance and investment goals. Pros and cons. The Sharpe Ratio is a useful tool for investors, but it's not perfect. One of the main drawbacks of the Sharpe Ratio is that it assumes that returns are normally distributed, which may not always be the case. Additionally, the Sharpe Ratio only looks at past returns, so it may not accurately predict future performance. To learn even more, check out the stock investing courses in the description.